I have a question for you. Do you know what the CF Montreal and BMO has in common? Well, they report unexpected losses. Yes, dear investors, welcome to this Canadian bank earnings review for Q3 already. Time flies, right? A lot of bad news this quarter. You're going to be shocked, and we're going to do a deep dives into the provision for credit losses, the PCLs, later on in this video. But first, let's take a look on how the banks have been doing so far this year. Last week, I did a video on how to analyze banks and how to understand them because they are not the same. Well, when you look at this graph, you can clearly see that those returns are also telling you that they are not acting the same way on the stock market. So it's not a truth anymore that you can buy any banks and it's going to do well. Since 2008, each of the bank decided to take one straight path towards growth. Some success with some failures, but now today their business model is completely different. And we're going to see in this video that the Canadian arms for each bank did incredibly well. The problem or the success actually came from the growth vectors. So let's get started with the dividend and earnings chart. So as you can see, no dividend increase this quarter, which was expected for everybody. However, I still highlighted the last two in red for CIBC and Scotiabank because CIBC was on a pace to increase twice a year. They skipped Q2. They didn't announce anything for Q3, so it seems that they're going to either have one dividend increase this year or nothing. For Scotiabank, it is already known, it is nothing. So keep in mind, yes, you get the yield, but you fail on keeping up your retirement lifestyle or your buying power because inflation still kicks in and the dividend you receive have not moved this year. For CIBC, I'm not too worried about because this quarter was very strong actually with earnings per share up 27%. We'll dig into this to understand exactly what happened there because when you see big numbers like this, there's usually a story behind it. However, there is a different story for National Bank at plus 24. And I also wanted to highlight that the adjusted EPS versus the regular EPS for TD was completely different. So adjusted EPS up 5%. $2.05. Everything is good, right? But shocker, the real earnings per share, so the one calculated based on accounting principle, is actually reported a loss of 14 cents. What happened there? We're going to see that in a second, but let's just say that it's not pretty. And in terms of payout ratio, most of the banks are around the 50%. National Bank is kind of crazy right now, under 40%. So in terms of like, is your dividend is safe? Yes, it is. For Scotiabank, we're not going to have a dividend increase, but it's a little bit more about prudent management at this stage. 65% is not that high, but we know how fast things can go, especially when we're talking about provision for credit losses that we're going to cover today extensively. So it could go wrong at one point. It is important to follow this metric every single quarter. But at this stage, all banks' dividends are safe. So now moving on to the segment reports. So the first one, Canadian Personal and Commercial. So that's what PNC stands for. Canadian economy is incredibly resilient, right? Every bank reported high single-digit to double-digit growth, led by actually CIBC and National Bank. Quite a surprise, but even TD did pretty well, up 13%. For your Royal Bank, there's the story where they acquired HSBC assets, so you have to make the difference between what happened, including the acquisition, which is plus 17%, and the excluding the acquisition, it's plus 7%. But overall, all just good news for the personal and commercial banking. The fact that they are operating in an oligopoly helps banks as well to protect their margin and to generate high returns on their loans. The volumes were there, the deposits were there, all good news. Now moving on to the interesting part here. So for National Bank, they have Credigy in the US and they have ABA Bank also in Cambodia. Both did very well. Earnings per net revenue was up 23%. Nothing to talk about here. It's just good news. Royal Bank do not report on their US and international. They're mixed into the other segments, so nothing to talk about for US and international on this bite. Now, where it gets very interesting is, of course, what happened with TD. So they reported a loss of over $2 billion. Kind of crazy, right? Well, this is all related to the anti-money laundering. We're going to keep talking about AML going forward, investigation in the US. So you already know that it's been a Damocles sword pending over their head for a few quarters. They started to record provisions for that AML investigation. They expect a settlement by the end of this year. We don't know if it's going to happen, but obviously there's a lot of things happening behind the doors right now. And if they have to report another 2.5 billion in provision for that AML investigation, it's not looking good. We're getting over like 4 billion in Canadian dollars right now of AML provision. Of course, that is the part that is actually the good news. Kind of crazy, right? But what I'm concerned about, TD, and I did a podcast on Moose on the Loose last week about that, is what happens if they have to pay a steep fine, which is obvious that's what's going to happen. And I told you before, HSBC had to pay like over $2 billion. But what I'm really concerned about is what happened to Wells Fargo. So Wells Fargo saw their growth capped by the DOJ. And this is not what you want for TD, because TD's main growth vectors is actually US. So if regulators are telling TD, well, you know what, we're not satisfied with your AML regulation, we are going to wait until we are satisfied with your practice, and until then, you're not allowed to grow your business until a certain cap. So where are they going to find growth? Well, that's a pretty good question. On top of that, they had to sell shares of Schwab to kind of like compensate for that, maintain a strong capital ratio, and get some liquidity. So again, not a good news for TD. And I'm starting to be a little bit more concerned about how this investigation is going to settle. It's going to come up in a few months, maybe, hopefully by the end of this year, so we can move forward after that, this analysis. But you have at this point to determine if it's a type of risk you want to keep in your portfolio or not. Because when you think about that right now, TD has not dropped too much on their results. So it's still time to take a decision without taking a huge loss. And we don't know what's going to come up next. Maybe it's going to be a fine, it's going to be a terrible year, and then we're going to move on. But just keep that in mind. For BMO, the US part was a killer. They have been increasing their provision for credit losses for several quarters now. We're going to have a full segment later on today on that. But at this part, that hurt the business big time. For CIBC, it's actually quite the opposite. Not too long ago, they had to report it. Very big, very important provision for credit losses for their US segment. This time, they kind of said, oh, well, it's not that bad anymore. So it goes back into the earnings, and that's what propelled a part of the earnings growth. For Scotiabank, for the international exposure, everything was well for this quarter, so that's good news. PCLs increases, but the business increases faster. Therefore, net income was up 10%. Now, for wealth management, it is quite interesting because National Bank, RBC, and Scotiabank did incredibly well, reporting double-digit growth, mostly on higher revenues and higher assets under administration, while TD and CIBC were flat. And then again, BMO had to report additional provision for credit losses and reported a net earnings down by 9%. Finally, capital markets, this one can swing on one way or another. Incredible quarter for National Bank, up 55%. In general, it was pretty solid, but CIBC took a hit at 21%. For BMO, which is usually a pretty important segment of their business, it was up 32%, so that was good news, but not enough to cover for the PCLs. Finally, I wanted to highlight the CET Tier 1 ratio. This ratio is really important for banks because they're telling you if they're well capitalized or not. So in other words, if their balance sheet is strong enough to face any kind of crisis. As you can see, all banks are showing a CET1 ratio above 13%, above Besides TD that is at 12.8, but that is because they keep on piling up those provision for the AML investigation. Again, big risk over their head. We don't know again how it's going to end up. So just be very careful with this one if you have it in your portfolio and determine if it's the type of risk you want to move forward with. Before we move to the most important part of this video about the deep dive into the PCLs, I wanted to offer you to download the Rockstar list. So what's the Rockstar list? Well, it is a list of companies that shows a very strong dividend triangle. So we focus on metrics here. So I use DSR Stock Screener and I pull out only companies showing revenue growth, earnings growth, and dividend growth over the past 5 years. That is an amazing starting point to grow your list of candidates and potentially find interesting stocks. We cover the Canadian and the US market. And most importantly, when you're investing in thriving businesses like this, well, you protect your retirement income. And that's pretty much the most important part, right? This list is updated monthly. So if you subscribe to my newsletter at dividendstocksrock.com/rockstar, you will receive the list today, but every single month in your email on Friday, you will receive an updated list of the Rockstar. So just go at dividendstocksrock.com/rockstar and download the list for free. And on top of the Rockstar list, you will have access to plenty of other reports and interesting tools to help you invest with more conviction. So for the last part of this video, I wanted to do a little bit more of a deep dive into the PCLs and also, most importantly, the ratio on the loan book. Why it's so important? Well, it's going to tell you where the company is going with their loans, and most importantly, if they are really strong with their underwriting process, or if they're about to lose control of their loan portfolio and start losing more money. So the first one we're going to look at is National Bank. This one's going to be quick because, as you can see, we have a relatively stable PCL from one quarter to another. It's increasing a little bit, but it's nothing alarming. And what is most interesting here is it's only 25 bips, so 0.25% of their loan portfolio. So while it increases a little bit, you can tell that National Bank's loan portfolio is pretty much in shape, and we should not have bad surprise going into the next quarter. Moving on to Royal, again, very stable. We are between 23 to 26 bips, a little bit more at 30, 31 in Q1 and Q2. But again, nothing too big, relatively stable for the PCL. So for National Bank and Royal Bank, it's not a surprise that they show strong earnings over the past few quarters. It's because they have their loan book under control and they benefit from other growth vectors. As for TD, well, we're now over $1 billion in PCLs, and that is nothing related to the AML provision. So that's another part they put aside, thinking, you know what, our loan portfolio may not be in that good shape. It's been 3 quarters, it's over $1 billion. So it's starting to get a little bit more concerning, but keep in mind, TD's banking model is a little bit more on the classic activities, which incurred a lot more mortgages and commercial loans than what we can see at National Bank and Royal Bank. The other thing that is concerning now is when you look at the total ratio for the PCL, again in bips, so 0.30% in Q3 of 23, all the way up to 0.40. So while National Bank and RBC were between 0.25, like 25 to 30 bips, now we're going up to 40 bips for TD. So again, another warning sign, definitely not looking where it's going. And now the unexpected heavy losses from BMO. And this is what concerns the market. It's been 3 quarters in a row where we crank up the PCLs every single time. Now we're up to 800 million. So now we doubled the PCLs versus last year, and it was still a big jump since the last quarter. This is concerning because it's telling you their loan portfolio is kind of getting out of control. When you look at the PCL ratio, we are now up to 54 bips. So we went from like 25, 30 for National Bank, Royal Bank, 40 to TD, and now 54 for BMO, that starts to get a bit more concerning, and that's why the stock price dropped by 7% on earnings day this week. Good news for CIBC, it has been a laggard for a while, but this year it's their year, and actually they got their loan under control. So lower PCLs boosted the earnings per share, and the PCL ratio is now at 29 bips, which is pretty much aligned with the best banks. So we can see that CIBC has the situation under control and that nothing should go wrong in the coming quarters. Finally, the last and definitely the least, Scotiabank. I mean, you know that I'm not a big fan, but I mean, when you look at the numbers, you can understand as well. So the PCL ratio is at 55 bips, so pretty much the highest one, even after BMO's getting their loan book out of control. It is more stable for Scotiabank, but still, you kind of expect, well, is it because their underwriting process is bad, or it's because they're dealing too much into the international business, and Latin America is probably not the best place to give out money for loans. Maybe that's the case. It's not the best loan portfolio that you can find on the market. So long story short, when you look at what happened over this quarter, you can summarize this into Canadian strong because the Canadian arm of all banks did incredibly well. AML, anti-money laundering investigation, that is going to hurt TD, and it may continue to hurt it for a few years if there's a cap on their growth. And PCLs, oh my God, now you have to really look at the ratios to see if it's under control. Anything under 40, I would say that it's pretty much under control. But for TD, for Scotiabank, and for BMO, though, this is a number that I will keep on looking going in the next quarter. So I hope that you have enjoyed this video. Don't forget to give me a thumbs up. It helps the channel to grow. Subscribe to the channel if you've not done already, and download the Rockstar list at dividendstocksrock.com/rockstar. All right, I'll see you in the comments to talk about banks, and until the next video, don't forget to stay invested.